The year is 1929. The world's richest nation is on top of the world. Then, in an instant, it all collapses. Everyone blames economics, but the real culprit was psychology. And I'm here to tell you, the exact same mistakes are happening right now today. If you don't learn from history, you're doomed to repeat it. And this is a lesson that could save your financial future. Let's dive into the first big mistake, the herd mentality. Back then, everyone was piling into the stock market. Your barber, your neighbor, even the shoeshine boy was giving stock tips. The logic was simple. Everyone's buying, so it must be a sure thing. But everyone's buying isn't an investment strategy, it's a warning sign. People follow the crowd right off a financial cliff. When you see a meme stock or a crypto coin going vertical and feel that FOMO, that fear of missing out, remember 1929. Following the herd is how you get trampled. Think for yourself, don't just follow the noise. Now for the second lesson, and this one is a killer, the leverage trap. In the 1920s, you could buy stocks with just 10% down. It was called buying on margin. This meant when stocks went up, your profits were magnified 10 times. Incredible, right? But when the market crashed, so were the losses. An estimated 90% of the devastating losses came from people who had borrowed money they couldn't repay. Debt is like gasoline. It can fuel your engine, but if there's a spark, it will burn your entire house down. Using leverage amplifies your gains, but it absolutely destroys you during a crash. Before you take on debt to invest, ask yourself if you can survive the worst-case scenario. The third mistake was the information lag. Back in 1929, news traveled by telegraph and newspaper. By the time most people heard the market was crashing, it was days too late. Their fortunes were already wiped out. You might think, well, we don't have that problem today. We have instant news 24/7, and you're right. We have more information than ever before. But here's the paradox. We still react emotionally, not logically. We see a scary headline and panic sell. We see a tweet and FOMO buy. We have instant information, but we make instant emotional decisions. The real advantage isn't getting information faster. It's learning to process it slower and more rationally than everyone else. And here's a bonus insight for you. The cycle never ever changes. It's a pattern as old as markets themselves. It starts with greed, as people chase easy profits. This leads to overconfidence, the feeling that you're a genius and can't lose. Then comes the inevitable crash, which triggers widespread fear and panic. After the dust settles, a new cycle begins. Greed, overconfidence, crash, fear, repeat. The key isn't to predict the exact top or bottom, but to simply recognize which phase of the cycle we're in right now. That awareness alone puts you ahead of 99% of other investors. So, I want you to do something right after this video. Go look at your own portfolio. Are you making any of these 1929 mistakes? Are you following the herd? Are you over-leveraged? Are you reacting emotionally to the news? To help you dig deeper, I've linked a fantastic book on market psychology in the description below. Our site also has a curated list of the best books on this topic. Understanding market psychology is your best defense against repeating history's costliest mistakes. Thanks for watching, and don't forget to subscribe for more insights that the history books don't teach you.